Peter Hans, and welcome to this week's episode of Between Two Chains. It is Wednesday, November 9th, right around 4 p.m. Pacific time, and this week I am joined by Arca CIO Jeff Dorman. We were all set to talk midterm elections, how it could affect the potential for speed of legislation and regulation in the U.S. for the digital assets market, and then um, you know, FTX decided to happen, and we're all fairly aware of that. So, needless to say, that dominated our conversation. We talked about kind of where we think we are as an industry, and how that differentiates from the technology, and then more importantly, kind of where do we go from here? What are the kind of key takeaways, and really, what about the need for frankly, regulation. There is transparency, but the need for kind of clear rules and around that transparency and regulation. Hope you enjoy the episode, and look forward to doing this a lot more in the future because we still are very early. Believe very firmly in this technology and the advent of this technology over the past 10 years. But, obviously there's a lot that needs to change and grow up as it pertains to the asset class. So as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Hope everyone enjoys the show. Thank you. All right, this is Peter Hans, and welcome to Between Two Chains. I am joined today, Wednesday, November 9th, another boring day in the market, by Arca CIO Jeff Dorman. Jeff, how are we doing today?
Look, as an intellectually curious person, I'm doing great. As an investor, there's some opportunities. As a steward of the digital asset industry, I'm a little sad and angry that we continue to get basically we're sitting on one of the, in my opinion, one of the most impressive technological achievements ever, and yet we continue to shoot ourselves in the foot as an industry to impede its growth. So, how's that for an intro?
Yeah, I mean, shooting ourselves in the foot is probably I don't know if it's a euphemism, but it's definitely moderate compared. It's more like shooting yourself in the thigh with a harpoon. Um, I mean, it's freaking ridiculous what just happened. This close to coming off the heels of Luna, right? And you know, we at Arca clearly, took lumps from that, but you've been there before. You learn your lessons. You adapt. You figure out how to move forward and not make the same mistakes again. But what does, like, arguably the biggest and most well-known name in the entire industry do? Like, make a very similar, and I can't even call it a mistake because it's not a mistake.
Well, we don't know the facts yet, right? I mean, there is certainly a lot of signs pointing to a lot of improprieties here for sure. But I think rather than speculate on exactly where the lines of legality versus incompetence are with regard to FTX or Alameda or anyone else involved here, I think there's some higher level takeaways that probably will withstand the test of time more than any individual opinions on who did what and who hurt who. Um, Part of what I try to do, this being almost 25 years now in capital markets across a variety of different areas, and I always try to figure out like what's new versus what we've seen before. And like, obviously there's nothing new about potential fraud. There's nothing new about bank runs. There's nothing new about financial firms getting in trouble or even pretend, saying everything's fine on the way down because they have to restore confidence even when things clearly aren't fine. Um, what's definitely more new is Twitter and how fast information gets out there. What's definitely new and pretty awesome is the ability to use blockchain forensics to uncover some of this stuff. I joked a minute ago, there was a headline that said the SEC has been probing FTX for 2 months. I'm like, well, great job, guys. It took crypto Twitter about 9 hours to uncover the problems. It took you guys 2 months and got nowhere. So it's like there are pretty awesome things that come with blockchain and some of these problems. But at the end of the day, I mean, we are in some ways just recreating problems that have happened for centuries, some of which could be um, prevented with regulations, some of which, again, I would argue that blockchain forensics is probably a better regulator than anything, just because there's so many people watching this stuff. But certainly it's a sad day for those who, um, have gone through a lot of the lumps already this year and thought that FTX was one of the safer places to be. The irony, of course, is why was Sam Bankman-Fried such a hero or appointed the leader of digital assets to begin with? I mean, that was more media driven really than it was industry driven. So it's just weird, I guess, right? I mean, this guy, for all intents and purposes, was getting senior traders coffee 5 years ago at Jane Street, and all of a sudden he became the king of the crypto empire. And it's hard to figure out how much of that was organic versus just the media crowning him king. But it certainly suckered a lot of people in, and it's definitely unfortunate.
Well, I mean, yes and no in terms of the media aspect, right? There's always a glorification of, I could call it like rags to riches, but like of a story like that, right? He's a young guy, um, MIT to Jane Street to, trading Bitcoin between what Japan and other markets, and launches, and tell me if where my time wrong is, like essentially launches Alameda, which is basically a quant fund, right? They get into other business lines, venture investing and you know market making. Who knows what else they do? And then then they start FTX as in essence, a complementary business for Alameda. But
More than even just complementary. I mean, the roots of FTX came from Alameda was such a power player in the digital asset space, trading on all the other exchanges, that they felt like some of the things they needed to do their jobs as traders better didn't exist on other exchanges, so they built one themselves. And it's one of those stories where how much of this started with real merit and real reason, and ultimately ended up not working out, obviously. But at least the genesis stories were somewhat um, an organic, interesting story, right? At least how they started.
well, real merit and real reason in the sense of like for the benefit of Alameda, not why you would normally start a business where we see a hole in the market and we are going to create a better exchange for the benefit of the market, obviously making money along the way. But this was always, it's essentially like, right, like Robinhood and Citadel Securities type relationship, right? More so than trade station or something like that, right? So and I guess the speculation comes in the sense of like, okay, well, if you're FTX, right, and you're supposed to, and it is truly, which it should be, a separate entity from Alameda, and it's a exchange, and clients have assets on the exchange for the purposes of trading and redeeming. Like, why would there ever be a solvency? Not that I'm commenting on their solvency, but like, why would there ever be a capital issue or a capital shortfall for an exchange? Right? You
Well,
deposit assets, they execute trades, you get it back, unless they're rehypothecating assets like a bank, but they're not a bank.
I think that's where look, a lot of the terms we use in the blockchain industry are not necessarily the most accurate terms anyway. Even the definition of an exchange, none of the actual digital asset, quote unquote, exchanges fit the legal definition of what an exchange is supposed to be, at least here in the US. But we use the word exchange, we use the word bank run. I mean, obviously, in theory, like you just said, you should not be able to have a bank run on an entity that is not a bank, because by definition, they should have all the assets there, right? So there's a lot of issues with that. I think, moreover, like, even an exchange who is doing everything exactly the way you suggested they should be, right? Where they're just saying client A deposits money here and they trade with client B through the intermediary of the exchange, you could potentially have a working capital issue, right? Where maybe some of the assets sitting there were put into treasuries or a bank account or something, and maybe you just couldn't get the assets right away, in which case you could have a 2 or 3 day working capital issue where you might need a bridge loan or some other way. But to actually have a capital shortfall, which again, we don't know, but that's what is being speculated right now, that does suggest that these guys were certainly doing a lot more activities beyond just what you would expect of an exchange. Um, so it's disheartening, right? And again, I think forget the glorification of Sam Bankman-Fried and him being a media darling and a TradFi darling and all that stuff. I think look, most people inside the industry like ourselves, we knew what FTX and what Alameda was. We used the exchange, but we certainly knew that there was some weird relationships there between FTX and Alameda. But again, I think it's hard because there you just went through a period where so many financial institutions have just been deemed untrustworthy, and there were so few places left to put your assets. And FTX seemed to be one of them that a lot of people gravitated towards, and that's just bad for the entire industry, right? I mean, you look at the list of casualties now from companies that are actually bankrupt or insolvent now. There's one very commonality of all these companies. These are centralized institutions that have a real CEO and a real board of director and real humans making decisions. And often these decisions are the wrong ones. Whereas the counterparts in the DeFi world that do the exact same thing, right? For every exchange, there's a decentralized exchange. For every lender, there's a decentralized lender. They're largely unscathed and operating, as is. And there's a reason for that, right? One, they're over collateralized. Two, they execute, brainlessly based on code without anybody saying, no, 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 let's not trigger them into default, or let's not execute a stop loss, or let's not put them into default here. Like, there's no ambiguity. It's just executing. So it's a huge black eye for the industry and for financial intermediaries in general. I'll even go beyond digital assets. I'll say all financial intermediaries, right? Because this is not unique to just the blockchain industry. It's happened in plenty of times in the equity and debt world as well. But it's a huge black eye for centralized financial intermediaries, and it's a huge, check mark for the transparency of blockchain and for decentralized code and applications.
Maybe. I mean, it's, I I don't think it's an issue of centralized entities being overtly worse than decentralized, right? I think it's an issue of we have a we have a technology that spawned a asset class that has a major part of it built upon um, recycling of financial transactions with no regulation really whatsoever and no oversight. And human nature is going to kick in and it's going to continuously, bite us in our collective ass, right? Um, and you would think that you would have like a little bit of a reprieve between each of these events, but it doesn't happen, right? So I think it's because like decentralized, like how many hacks are there? Like at the end of the day, there's still people in charge of writing and testing the code for decentralized protocols, exchanges, and how many times have they hacked and you're left with nothing and there's nothing you can do about it, right? Um, like
The flip side of it is the longer the code exists, generally the more safe it is sort of the rule of thumb. And
sure.
a lot of them, but yeah, you're 100% right. I mean, there's, well, I'll put it another way. Let me put it this, because I know you have a background in Washington. Well, let me ask you a question. Like, you think about some of the bigger regulations that matter in finance, right? One is FDIC insurance, right? The ability for the government to backstop, deposits at banks. Another is clearly
Mm-hmm.
reserve ratios, right? At banks and other,
Mm-hmm.
you have to have
Which
a certain
came
amount of,
about post 2008, tier one
exactly, right.
capital ratios and the like. Yeah.
Another is a clear segmentation of client funds, right? Even in the wake
Yep.
of even in the wake of Lehman, right? Most clients were not affected. Lehman basically was taken down by its own bets and its own
Yep.
issues, but the
Absolutely.
client were segregated. So there are some things that really matter. But if you actually think about it for a second, um, the reserve ratios are not enough to prevent a bank run. If a bank run actually happened, the reserve ratios are not enough to handle it all, right? If 100% of everybody pulled all their assets out, the reserve ratio isn't going to help. What the reserve ratio does is it gives you some confidence that a bank run won't happen to begin with and maybe prevents a bank run from happening. But it wouldn't actually solve anything if there was a bank run. Same with FDIC insurance.
Well, reserve ratios aren't so much to protect against deposits. They're there to protect against bad loans, right? And equity capital. Because like to your first point, right, your deposits are guaranteed by the FDIC, right? Well, up
Up
to
to a certain
250K.
point. Right.
Yeah, up to some point,
My
right?
point is, it's not like it's not. My point is, the regulation doesn't mean you're fully covered. The regulation is supposed to prevent some of the issues that happen, like bank runs and pulling all your deposits out and things like that. So there's no doubt that some level of regulation and a government backstop matters. But at the end of the day, what you really care about is the transparency, not the backstop. The transparency is what you still don't have in traditional finance, even though you have the government backstop. Whereas in blockchain or in the digital asset world, you don't have the government backstop, but you do have the transparency. And I think what we're finding is the transparency is awesome if you use it, right? But exchanges don't, the centralized exchanges are not being forced to use it. They're not being forced to say, hey, here's the wallet where our reserves are, or, here's wallets that you can track to see us, right?
Mm-hmm.
The decentralized protocols that are, anything that's fully on chain is basically a public, transparent database that anybody can check. And shout out to all the blockchain detectives and forensics, anybody who knows how to read a block explorer and can look into this stuff. I mean, it
Shout
is
out.
amazing. Yeah, I mean, seriously, if you have an hour free or maybe 12 hours free, go search some of the Etherscan records from about FTT and Alameda. I mean, literally, it took 12 hours for crypto Twitter to figure out all of the wallet movements and transactions that happened between FTX and Alameda. The
Yeah.
difference is if you were doing that on something like a Uniswap or something like a Sushi Swap or something like a DYDX, truly, automated, decentralized protocols, all of the transactions are 100% transparent. Whereas if you do it on an FTX or a Genesis or an Alameda or any of these other companies, you're only getting a piece of what was disclosed by these companies, and they are not being
Mhm.
forced to disclose everything. So I think again, like it's awesome that this level of transparency exists. It's awesome that there are people out there who, in a couple of hours, can uncover these things. I mean, think about how long Madoff was doing what he was doing, and versus how long this was happening. I mean, it's like it gets Madoff took 3 years to be uncovered. This was uncovered in 12 hours. So it's just pretty unbelievable what these blockchain transparency can do if it's used properly and if there are certain rules with regard to what needs to be disclosed and what doesn't. So I think we're not that far away. It's just we don't have that little, carrot or stick, I guess, rather, to force everyone to fully utilize the powers of what blockchain transparency can offer. So I'm encouraged from that regard, but it is certainly tough to swallow on a week like now where there's so many people impacted by this.
Well, I mean, look, there's transparency, right? But you can still have private blockchains, that aren't designed to be transparent, right? The issue with is really about how the asset class and activity is regulated or not regulated, right? Like, just assuming that, and I haven't looked into it really at all. I haven't had a chance, but looking at it seems like one of the things that really, led to a tipping point was, if Alameda is in trouble and FTX can make a loan to Alameda, um, in the form of, like FTT tokens, right? Like now all of a sudden you're completely obliterating the arm's length relationship between those two and, underwriting loans in a, in a way that's, probably, not ideal. Let's just say to put it loosely. And, and again, like that's not what exchange customers are signing up for per se. But again, there's no regulation, so um, that needs to be solved for. Like all the transparency is great, and this was transparent, but like without clear rules, you don't even really know what to look for.
Well, right. And the question is, can you prevent these things from happening, or do you just want to be able to catch them fast when they happen, right? I think that's what you mean by like, if there is a transparent record of it, you can always catch it, but can you prevent it? And I think that's difficult, right? I mean, even look at like for example, I was a trader in the corporate bond market for a long time at Merrill, Citadel, some other places. Like there was nothing stopping me from doing something completely erroneous, right? I could have traded 100 million bonds at 50% discount to fair value, and it would have gone through. Now there was ways that they could catch me after the fact, and certainly reasons why I would not want to do that and go to jail and things like that. But there was not a lot they could do to prevent me from doing something. It was more
But
that
it
there
was,
was.
but it's clearly illegal, right? Like and there's internal controls and maybe it's like a cultural issue or something. But like in this case, it was, whether it was a true gray area or whether it was a, internally justified, rationalized gray area, who knows? But it's not, if you're a JP Morgan and you go do something that's like very clearly a compliance violation or illegal, like, yeah, maybe you can do it, but like, you're going to get caught immediately. You're going to get fired. Like, you know exactly what you did. The bank's going to get fined. Like, it's all
Right.
very clear.
Yeah, I mean, I don't know. It's all very clear, but yeah, I mean, like you said, but the safeguards are in place to stop it once it starts. There's still very little to prevent it from happening in a lot of cases. So I think it's not the easiest thing to solve for, um, holistically, but there are certain things that are incredibly easy to solve for, right? Like if you are going to operate an exchange, whether in the U.S. or somewhere else, and I think CZ at Binance actually tweeted this just yesterday. He said the same thing. He's like, from now on, this industry needs to start putting out reserve ratios and wallets. Like there's no reason not to do that. That is a very low hanging fruit that doesn't need regulation. That needs customer pushback. Like, hey, please provide this or we're not going to trade on your exchange. Like that's the kind of thing that can happen voluntarily without necessarily regulation. Now, maybe that becomes regulation in the future as a result, but just sitting around waiting for regulators to do things when some of this stuff is so obvious and easy, it may be faster and more beneficial to have an uproar from the community and the customers more so than sitting around waiting for regulation. Regardless, I think it's clear that in this case and others that have happened this year, um, at least some of this could be prevented through better regulation. And alternatively, I do think that there's a reason that the percentage of overall trading that happens on decentralized exchanges has been rising relative to the overall volume. I mean, there's a reason for that. It's not for everyone. Some people feel much safer knowing that you have a centralized entity looking out for you, and if you make a mistake, maybe they'll refund you and stuff like that. But like, there's definitely the data is suggesting that more and more of the volume in the space is moving on chain rather than off chain, and I think that's a reflection of the issues that we've had this year. Again, like 17 out of 17 of the problem childs have been centralized entities.
Or is it more because you talked about percentages of the trading volume, and if overall trading volume is dramatically lower than it was last year, is it just like the people that are left now are the real in the weeds crypto people,
Or
whereas
maybe,
the
or maybe they're the
marginal
only ones.
dollars left?
Yeah, I was gonna say, or they're the only ones with assets left because everyone else's assets are stuck on FTX and Voyager and
Well,
Celsius.
God, I hope not. But you have Coinbase, and again, this FTX thing is recent, like the decline in volume and trading activity. I mean, the market has turned into a bit of a zero sum game over the past few months, right? Meaning like the market is not growing. It's we're shuffling deck chairs on a cruise ship.
Yeah, and I think, I mean, look, one of the questions we keep getting to is then like, what happens next, right? What's the next domino to fall, right? I mean, you mentioned Luna UST earlier. That happened May 10th, and it took, I think, about 3.5 weeks later before Three Arrows eventually went under, as well as Celsius and some others, right? So I think people are now saying, okay, here comes another big event. Who's next? And of course, the rumor mill starts to circulate, and nobody really knows. But I think, in my opinion, in order of kind of who is the most hurt here, I think the first is Bitcoin miners. That was true even before FTX had its issues, and probably continues to be true, right? One is you have hash rate rising, which basically just means it's more competitive to mine a block. At the same time, you have price going lower.
Mhm.
Eventually you get to a point where it's just not economical to mine anymore, and you've seen a ton of miners selling over the last 6 months, trying to just cover costs as best they can. I think the mining industry is still going to see a lot of hiccups. Um, and that affects obviously Bitcoin and maybe to some extent Litecoin more so than anything else in the market. The next tier is really relative to what
Litecoin's
happened.
still a thing?
Yeah, still thing. Um, I think it might be the first time I've mentioned it in 3 years, but it exists. But the next group I think that really suffers here is the market makers. Market makers by definition have to make markets across all these different fragmented exchanges, right? So if you're trying to make markets on Ethereum, you have assets on, as an LP in decentralized exchanges. You have assets at FTX and Binance and OKX and Huobi and Coinbase and Gemini and Kraken. A lot of those assets are now frozen on FTX. Now, some of these, market makers will have pretty good risk controls and have limits to how much they are now stuck on FTX, but it means that they're definitely going to have a hard time making markets going forward from a capital efficiency standpoint, which means liquidity in the market could get worse. Um, and then you also have the lenders, of course, right? The lenders already having suffered major problems with Three Arrows, the biggest hedge fund to collapse prior to now Alameda. But a lot of these market makers, a lot of these miners, and a lot of these hedge funds do take a fair amount of working capital loans from these lenders. Both on chain things like Aave and Compound and Maker, as well as OTC. With your larger players, your Genesis, Galaxies of the world, et cetera. There could be some issues there. And I think, most of the biggest lenders in the space have done a pretty good job of now coming out in the last 48 hours, telling exactly what their exposures are. But this is really, again, where that trust comes into play, right? It's hard to believe anyone right now when they say something. And that's really the crux of what blockchain is supposed to be, is that you don't have to trust because you can verify. And here we are waiting for announcements from CEOs to tell us they're fine. So it's a little ironic, certainly. It doesn't mean this industry is dead. It's more and more signs pointing towards which parts of this industry need to do better and which parts already work great, and we just need more participation. But it's definitely an ironic state that we're basically recreating the 2008 financial playbook, even though we are doing it built upon a technology that was built to uh, skirt some of these issues.
Yeah, and the part about it doesn't mean that the industry is dead. Um, or like certainly the technology, right, of blockchain is not dead. I don't think anything has changed there. I think we're still in an environment where, long term, let's think in, decades, we will see implementation of blockchain as a technology across the economy globally. The market, as we know it today, you know, yield farming and you know, you know, moving in and out of these, momentum trading and like people looking at charts and just like that. I don't know. Maybe it is dead. It probably should be dead. It's it's garbage. It's like a bunch of children playing day trader. Like people, no idea what the hell they're talking about, and like maybe that is dead. I hope it's dead in a lot of ways, right? That I separate that completely from the innovation side of the market. But again, I think it all comes back to like, what is this going to look like as a regulated um, asset class?
Yeah, well, there's a couple things with regard to that. Like I actually went back and for some of you might know, I've been writing a weekly blog really for 5 years now called That's Our Two Satoshis. It's up on the Arca website, ar.ca/blog. I went back and looked at something I wrote in December of 2018 when it also felt this dire and it felt like the industry was never going to recover. And it was interesting writing it and looking at like what I basically was saying was like, okay, you need new capital to come in here. You need new people to come in. Like who is going to be the crypto Carl icon? The ones who actually want to buy distressed assets instead of just these momentum traders and yield farmers and things like that. And when you go back and think about what I wrote there versus what happened, well, look at where all the money was made over the last 4 years. It was the newcomers who came to the market, right? It was your multi-coins who came in and had big funds. It was, companies like Arca who came in with new capital. Galaxy made a fortune from it. You had the Brevin Howards of the world getting involved in the market. You had your jumps getting involved. I mean, there was a complete new wave of participants that came in that 2018 2019 time frame that were able to buy very good assets at very depressed levels. The total market cap of digital assets was about 100 billion in December of 2018. It's still 900 billion after a down 75% year. So you have a 9x gain now over the last 4 to 5 years. And a lot of people came in with new capital and made money at the expense of those who blew up in 2018, 2019. And, unfortunately, you're seeing the same thing here, right? There's been a lot of blowups. Your Three Arrows, your now Alamedas, your Celsiuses and things like that. But there will be new capital that comes in. The assets themselves are not dead, right? Ethereum is still producing blocks. There is still a lot of NFT activity, a lot of stablecoin activity, a lot of DeFi activity. There are things happening that make the assets better than the asset class right now, right? The players in the asset class are hurting right now. The assets themselves, some are going to go away and some are going to be, the next 10 or 20 or 50 baggers for new participants to come in and buy. So it'll be interesting to see how that capital comes in and where it comes in from. And separately, I think also we joked about Litecoin a minute ago because Litecoin was one of those 2017, 2018 assets that people thought were important, and now, of course, it's completely pointless and just trades for the sake of trading. But also, that's what we're looking at right now, right? Which of the assets that exist today will still matter in 4 or 5 years versus which ones will die and which new assets will come in? And I think the big difference there is that a lot of the new assets that are going to be created are not going to be these organic infrastructure plays of blockchain. They're going to be from companies that have existed for 100 years. I mean, you're seeing it. I mean, look at the last 3 months alone. KKR tokenized one of their funds of their private equity firm. Nike is selling NFTs and making tens of millions of dollars. Starbucks is heading that way with an NFT launch. Reddit is doing it with NFTs. You have traditional JP Morgan just executed their first DeFi transaction. So you look at kind of what's coming next, and it might not be the next layer one protocol or the next DeFi app. It might be the next Disney or the next, Netflix or the next, a company with 100-year history that starts to utilize blockchain. And that might be where the investment opportunities of the future come from. So it's pretty fascinating when you try to separate the investment assets from the players in the investment industry right now. So it's encouraging from that standpoint. And I think it's anytime you can go back and reread exactly what you were saying or thinking in the moment in a very similar time period 4 years ago, it's always worthwhile. I tend to do that a lot. Go back and read old investor letters, old blogs to see what the sentiment looked like, in similar times to today and what the aftermath of that was. And obviously we know, 2020, 2021 was a pretty good investment window, after the carnage of 2018.
We'll talk about it. I mean, obviously everything's a little bit different, right? I think one of the differences is you didn't, probably have as much, well, not probably, you didn't have as much capital, right? And like an institutional eye on the space in 2018 as you do now, right? And as you did over the past couple of years. But for the audience that wasn't intimately involved in, say, late 2018, okay, well, in between, 2018 and 2020, 2021, you had, 2019 and everything kind of like right leading up to COVID and like the easiest monetary policy we've ever seen. So, what do you recall from 2019? Like, what was that environment like?
Yeah, it's so before we got to March of 2020, which is what you're talking about with the monetary policy and the stimulus and basically an 18-month bull market across all asset classes. 2019 was very up and down. First couple of months of 2019, there was definitely what I referred to as the cavalry arriving. There were some people in the digital asset space who were like, enough's enough. I'm tired of this market going down 90%. Like, I'm buying. And there was very public buyers. Like Mike Novogratz at Galaxy was a very public buyer. The Ethereum Foundation was a very public buyer. You had Pantera, one of the oldest digital asset hedge funds, was a public buyer. There was the cavalry kind of arrived to say, "This is crazy. We're going to put some money to work." That was the first thing we saw. Then you started to see in the second quarter of 2019, that was Bitcoin's kind of first real run while people were paying attention to it. You had a pretty big move, well over 100% in the second quarter of 2019, driven partially by monetary policy, but also partially because there was rumors of corporates and others getting involved in the space. And then you also, that's when you first started to see some of the footprints of real applications being built on Ethereum and mostly Ethereum, but a little bit of other layer ones as well. That's when you started to first see some real beginnings of what was happening in stablecoins and DeFi. So it was nothing compared to what we have saw in 2020 and 2021 with regard to activity, right? I mean, stablecoins were a couple $1 billion maybe at most in 2019, and now they're 200 billion. DeFi hit a TVL of 200 billion at one point. It was probably less than a billion, but you started to see those building blocks in the same way that I'm saying right now. You're seeing the building blocks of Starbucks and Nike and JP Morgan and others. So in the moment, it maybe wasn't as obvious that we were really coming out of the depths of hell and into this building and growth phase. But looking back on it, you could definitely see it. And some of those same signs are starting to emerge today.
Yeah. I mean, I can see that. I mean, I'm wondering where, like, the thing about the cavalry. I mean, the cavalry's taking it on the chin a little bit over the past few months, especially the past few days.
You might need to call in for some reinforcements, but don't forget, there's a lot of wealth in the world, and as you mentioned, there's a lot more people who know about blockchain and digital assets.
Yeah, that's true.
I promise you, as we're talking today on November 9th of 2022, we're going to hear a year from now, November 9th, 2023, there'll be some massive write-up of the next Sam Bankman-Fried, the next guy who made billions of dollars because they started investing around this time period. So there are people and groups and individuals and firms who are mobilizing right now who have tons of cash who have not been scaled. I mean, it as even in our own even in our own capital raising at Arca into various fund strategies. You see it, right? The people who are already in this industry are certainly getting hurt a little bit. The people who have already committed to investing in this industry but haven't done it yet are licking their lips. They're like, "Oh, this is great. I already have it improved, but I haven't made any investments yet." So there's always new capital, coming in that can kind of provide that next bit. In a perfect world, you'd love to see more distressed buyers be like, you'd love to see more oak trees of the world be like, "This is great. I'll buy some here. And if it goes down 50%, I'll buy more." In reality, most people don't do that, right? They want to see it go up 20 or 30 or 40% before they start buying. But, pretend that there's not capital out there to buy some of these assets is crazy. I mean, we're talking about an $800 billion asset class right now that 10 years from now could be one of the most impactful technologies ever.
100%. Yeah, no, and I'm not implying that, but I'm just saying, if it's people in the industry right now, I mean, like, they're worried about keeping the lights on, they're, for the most part, but I definitely agree. I mean, there's plenty of money on the sidelines, and I don't think anything is changing long term with respect to that. I think it's circular. I think it comes down to regulation and like having clear rules in place. But we could see it.
Well, yeah, and it goes both ways with that, right? I mean, you hear a lot of people right now saying, "Well, this is great. This FTX blow up is a negative because it's going to need more regulation." And there's people like us who are like, "That's great. More regulation faster would be fantastic. That would make it much safer to invest in the space, and there'd be way more money coming in." So I think there's still a little bit of a bifurcation of ideology there with regard to what regulation means. But I think at least in terms of where most of the capital in this world comes from, they would like to see more regulation faster than not. So hopefully this is another trigger to get that. We'll see. But I think it's there's no doubt that there will be new winners that come out a year or 2 years from now. because of what the events that are happening right now today.
Hmm. Yeah, I think that's right. I think that's right.
So I think, I guess in terms of words of encouragement for anyone listening to this, I think, like it is always hard, right? If you have assets stuck on FTX, or if you had assets stuck on Celsius, or you lost a fair amount of money, it is definitely hard, right? Conversely, if you already are in this industry for real reasons and believe in the future of the space as much as we do, and some others, there's not a whole lot that has changed with regard to what the future looks like.
Hmm.
So it's, there's there's uh there's a human psychological element right now of getting past the anger and the disappointment and the losses, and still kind of focusing on why we're here in the first place. So, um, obviously, I've been through a fair amount of cycles, both now within digital assets, but also well before. It never feels good, but it's certainly where most of the money is made, and certainly where a lot of the interesting opportunities come from. I mean, I started this by saying, as an intellectually curious person, I'm just all over the place right now looking for what's going on in this market, where you can find little edges, and in blockchain explorers, and in some of the data. So there'll be a lot to talk about over the next few months, that's for sure.
How are you thinking about? Oh, well, not how are you thinking about? Obviously you talked to a lot of people from the traditional finance world, kind of looking to break into the industry. How has that changed, if at all, over the past few months? And I mean, obviously, it's too early right now to see how some things might change, but
Well,
what's your sense there?
a lot of people looking to break in the industry are coming from other industries that are not doing so hot either. Real
That's
estate,
fair.
equities, fixed income. So it's not a. I wouldn't say the grass is greener necessarily on the other side. I think the big issue really is 2021. Every company was hiring, 4x, 5x. Now, obviously, those opportunities are slimmer, and there's a lot of layoffs happening. So, I don't think the interest in this space has gone away. Maybe some of the seats have gotten filled or taken away. Um, but there's a lot of, certainly anecdotally, the people I speak to in the traditional finance world. I mean, a lot of them see the writing on the wall in terms of their jobs as well, and some of the things that continue to get automated over the last couple of decades, and that's not going to stop. So, um, I think it is a really, really, when I was a kid, it was you had to learn Spanish. Then it was like you have to learn Mandarin. Then it was you have to learn the right computer code. Like you have to learn blockchain now. I mean, that's the next skill set. You have to learn how to read a blockchain explorer, how to understand code audits. I mean, that's the next real opportunity in finance and beyond. And I do really truly believe that just about every company and institution in the world will be using blockchain in some capacity. So, the opportunity from a career standpoint certainly hasn't gone away.
Mhm. No, I agree. I definitely agree. Just um, yeah, interesting. I mean, what what can you say right now? I mean, I guess right now, obviously, it's a little bit of a scary environment, and it just goes to show you how quick things can happen and unravel here. But I think ultimately the technology is very different, and that's obviously why you and I are here. So, um, anything else you'd like to add or focus on?
Yeah, I think, this is a time for research. It's a time for talking to people. Pick up the phone, call people, reach out to, us at Arca, ask us questions. I mean, the more you talk to people, the more you learn right now, certainly the better you'll be. So, I always look for where the opportunity is, not commiserate on the lost opportunity. So, there's certainly no
Yeah,
shortage of that.
yeah. No, I think it's well said. Well said. All right, Jeff. Well, as always, enjoy the conversation and appreciate it. And we'll talk soon.